Are you really sure you want to bet against Warren Buffett? In 2000, the market crashed because of the internet bubble. In 2008, it crashed because the banks ran into a liquidity crisis. Today, we may be facing both at the same time, an AI bubble forming at the top and rising liquidity risks in the banking system below. If 2000 destroyed the internet bubble and 2008 destroyed the banks, what happens if those two forces collide together this time? Before 2000, if you bought US stocks blindly and just held for a few years, your money would normally grow. Before 2008, same story. Most of the time, US stocks go up more than they go down. That's why shorting the market before a crash is so hard. But here's the uncomfortable problem. Buffett has already shorted the US market twice. The first time he said, I don't understand the internet, so I can't buy. Then the dot-com bubble exploded. The second time he warned, financial derivatives are weapons of mass destruction. Then the 2008 financial crisis hit. This time, he has said two key things. He doesn't really understand AI, so he won't chase it. And he's clearly worried about currencies that are going to hell, especially under weak fiscal discipline. So, what is he really telling you? Most people think shorting means doing what Soros did. Borrow shares, dump them to crash the price, buy them back cheaper and keep the difference. But that's just one method. At its core, shorting has only two steps. Sell high, buy low. Before the crashes in 2000 and 2008, the markets were hitting record highs. What did Buffett do? He quietly sold stocks. That's selling high. After the crashes, when prices were on the floor, he went in with a mountain of cash and bought. That's buying low. You can call it what you want, but in effect, that's also a form of shorting. Buffett does short. He just does it in a very quiet way, without drama, without crashing the market himself. And by the time you realize what he did, the move is already over. Now look at today. Recently, Buffett's company has built a record cash pile, close to $400 billion sitting and waiting. That's more cash than many central banks in the world. Do you really think at his age, he builds the largest war chest of his life just to stare at it? Remember, this is not free cash like yours. Most of it comes from insurance float, money that technically belongs to policyholders. He pays a cost to hold it. Inflation eats it. So for him, this cash is actually a liability he must justify. He parks this money in short-term US Treasury bills just to earn some interest and reduce the cost of holding this giant debt-like pile. So ask yourself what kind of opportunity or danger is big enough. That Warren Buffett is willing to sell so many stocks, sit on almost $400 billion and wait. Some people say he just wants to leave more flexibility to his successor, but be honest with yourself. If you built an empire, would you sell your best assets, turn everything into cash and tell your kid, here, do whatever you want? That doesn't sound like Buffett. There is a much simpler explanation. He sees a risk ahead that most people are still blind to. He has already finished step one of shorting, sell high. He's been cutting down positions while the market hits new highs. That's how this historic cash pile was built. What about step two, buy low? Earlier this year, when the market dropped more than 20%, did he rush in? He didn't move. And when the market bounced back, he took the chance to sell even more. That tells you something very clear. A 20% drop to him is just an appetizer. He's waiting for the main course. So you have a choice. You can follow the crowd, buying at all-time highs, hoping it always goes up. Or you can pause and think out, what tsunami is the man with the biggest cash pile in history preparing for? If you decide to follow Buffett's thinking, you cannot ignore these signals. One major crash in your lifetime can completely rewrite your financial story for better or for worse. And Buffett is not the only one pulling money out. Top insiders and founders from the biggest tech and AI names have been selling billions worth of stock. Even some of the loudest AI believers have started trimming positions and warning that current AI valuations may face a reality check. So people now ask the same question again and again. US stocks, gold, silver, everything is already so high. Can we still buy? That question exposes a beginner mindset waiting for insider news. Blindly long-term hold without risk plan, dreaming of buying low and selling high, but ending up buying high and selling low. Why does this happen? Because small investors are trying to copy big players' strategies without the information, tools, and capital that big players have. We don't have insider news. We don't know where the bottom is. Trying to catch the bottom is like trying to catch a falling knife with your bare hand. The good news, we don't need to predict the exact top or bottom. We don't need to predict when the bubble will burst. We just need to ride the wave inside the bubble and get out before it explodes. When you are too scared to buy, we are already using AI to scan the market. When you are too scared to buy, we are already using AI to scan the market and pick our entries. When you are panicking and cutting your losses, we have already unlocked in profit. And not because we are braver, but because we let AI do the heavy lifting. We use systems that read big player buying and selling signals, automate exit rules, and focus on protecting capital first. We test different AI investment tools with real money, and we show the real P&L. So you see clearly which AI tools actually work and which are just hype. Normally, access to this inner circle is $800. But if you're already my follower and you are serious about surviving this market, I'm opening it up for free again until the seats are gone, like last time. Now, back to the real question. If these big players are all selling and hoarding cash, what are they really waiting for? They are waiting for a liquidity crisis big enough to reset the system. This time, it may not be just another Lehman Brothers. Now, let's talk about AI and NVIDIA. US stocks have hit new highs. AI champion stocks have exploded. Look at NVIDIA. Its market cap has crossed $5 trillion. What does that mean? It's about 1.1 times Germany's entire economy, about 1.2 times Japan's economy, about 8 times Taiwan's economy. If we treat NVIDIA as a country, it would be the third richest country in the world. And how many employees does NVIDIA have? Around 36,000. And that's not even 3% of Foxconn's workforce. So logically, you might think if NVIDIA performance keeps getting better, its profits grow and its stock price rises, then the US economy should also become stronger and Americans should become richer too, right? Let's check the data. After the Federal Reserve cut interest rates last year and this year, did the US stock market reach new highs? Yes. Did AI companies like NVIDIA make more money? Yes. But what happened to US jobs? The non-farm payroll data kept getting worse. Employment was weakening. And what does that mean? The Fed said, we are cutting interest rates because employment is weakening and we need to stimulate the economy. In textbooks, we learned when the Fed cuts rates, borrowing cost goes down. Businesses borrow more. They expand, hire more staff. Employment improves. But what are we seeing now? The Fed cut rates, yet employment kept dropping. This means rate cuts are no longer improving jobs. And the official employment data only goes up to August. Because after that, the US government shut down. So no one was around to publish the numbers. But we still have another data source, a firm called Challenger, Gray and Christmas, which tracks layoffs and hiring. According to their report, in October, US employers announced 150,000 job cuts, an increase of 175% compared to last year. This is the highest October layoff number since 2003. Put simply, the degree of firing people last month, that was worse than during the 2008 financial crisis, and even worse than 2020 COVID crash at that time. So what does all this suggest? Rate cuts did help AI companies like NVIDIA to make money, but at the same time, more and more Americans are losing their jobs. And this is not just about tech. You can search the news. Microsoft is laying off. Meta, Facebook is laying off. Amazon, Google, UPS, basically every major US giant you can name has been cutting people aggressively. Why? There are two possibilities. Possibility one, AI really is replacing humans. The Fed cuts rates, companies borrow money cheaply, but instead of using it to hire more people, they use the money to buy more NVIDIA chips, develop stronger AI models, automate more tasks, replace more human workers permanently. So it becomes a vicious loop. The Fed sees more people are unemployed. It cuts interest rates to help. The money flows to big AI firms. They build stronger AI and cut more staff. Even more people lose jobs. So rate cuts equals more AI spending equals more unemployment. This is very similar to what happened before the Great Depression in 1929. New technology raised productivity. Work that previously needed 10 people could now be done by 1. 9 people lost their jobs. And these 9 people had no income, so they stopped spending. Spending dropped. Businesses like restaurants, shops, banks lost revenue and also started to close and lay off. And if the Fed keeps pumping more money, and that money keeps flowing to technology that replaces humans, then paradoxically, more stimulus can lead to more unemployment. If you believe AI is like a third industrial revolution, then the more money the Fed pours into AI, the more people will lose jobs, and the more the economy can actually worsen. Possibility 2, AI is a bubble, and they're playing a money game. Is that AI is partly a bubble, and big tech is playing a left foot steps on right foot game. NVIDIA invests money into OpenAI. OpenAI uses that money to buy Oracle's cloud computing power. Oracle, after getting this money, uses it to buy NVIDIA and AMD chips. Nvidia and AMD then invest again into AI projects like OpenAI. So the same money circulates between a small circle of companies. On paper, everyone's revenue increases, financial reports look great, and stock prices rise, but no real broad-based economic value is being created for ordinary people. Whether you believe AI is genuinely replacing human work in a lasting way, or AI is a big bubble pumped by financial engineering and money circulation, the result is the same. More money goes into AI, more people lose jobs, consumption weakens, and the economy gets worse for ordinary people. The huge wealth created by the AI boom mostly gets captured by top capitalists and major shareholders. The cost, unemployment, lower spending, weak economy is paid by the average person. Maybe you don't believe all of this now, and that's okay, but at least think carefully about the logic. If you have better ideas or different views, share them. Let's discuss rationally. I will continue to share free information on becoming wealthy, becoming an entrepreneur, and achieving financial freedom. And if you don't want to miss it, subscribe, turn on the bell, and share the videos. I sincerely wishes that those who like and support my videos can reach financial freedom as soon as possible. If you can find even 1 or 2 sentences in my content that help you live a better life, I feel satisfied. See you again. Bye.